Welcome back. If you want to know where the global economy is heading, you can do one of two things. You can listen to 1,000 economists on TV who are paid to be measured and cautious. Or you can look at one single chart. The economists are paid to give you feelings. The yield curve is paid to be right. In the global bond market, which is by every metric the most important market in the world, this isn't just a graph to point to during a presentation. It's the temperature gauge of the entire global economy. It's the crystal ball that doesn't lie. Not stocks, not crypto, not the latest leveraged ETF your bro keeps bragging about. Professional traders, the smart money, obsess over the 2s-10 spread. It's the gap between the 2-year and the 10-year Treasury yield. That gap is the heartbeat of the financial system. It tells you if the economy is healthy, if it's having a heart attack, or if it's currently on life support. If you can read this line, you don't need a PhD from an Ivy League school. You'll see the recession coming while everyone else is still buying the soft landing myth being sold on the evening news. Today, I'm going to show you how to read the slope like a pro, why the 2026 De-Inversion is the most dangerous trap in finance, and how to spot the death rattle before the floor falls out. Before you can read the curve, you have to understand why this line exists in the first place. It's based on a concept called the time value of money. Think about it like this. If you lend your buddy $100 for a week, you might not ask for much interest. It's just 7 days. You know where he lives. You know his job is secure for the next week. But if you lend that same $100 for 30 years, you're going to want a hell of a lot more back. Why? Because a lot of bad stuff can happen in 3 decades. Simply put, more time equals more potential risk to you getting paid back. Inflation can eat the purchasing power of that money. Your buddy can get hit by a bus. Or the government could decide to start printing trillions of dollars, which, let's be honest, is the only thing they're actually good at. In the bond world, we call this the uncertainty of the future. Every extra day you are separated from your money is a day you are at risk. Remember that brilliant idea of 50-year home mortgages that was floated recently? Go ahead, try asking a button-down banker for a loan 20 years longer than a conventional 30-year loan. I'm sure you'll get a great rate. He's going to charge you out the nose because he has no idea what a dollar will be worth in the year 2076. He has to price in the risk of the unknown. In a healthy, functioning world, long-term debt always pays more than short-term debt. Investors demand a term premium for the risk of time. This is what we call a normal yield curve. It slopes upward. When the curve is normal, the economy is in its golden hour. People are investing, businesses are expanding, and liquidity is flowing through the system. It means the market thinks the future is bright, and the bartender, the Fed, is keeping the drinks at a reasonable price. Banks love this environment. They borrow from you at low short-term rates, your savings account, and lend it out at high long-term rates, your mortgage. That gap, the net interest margin, is their profit. When the curve is normal, the engine of capitalism is hitting on all cylinders. But when that line starts to flatten, that's when an experienced investor starts looking for the exit. So we touched on a normal yield curve. Everything is fine and everyone is happy. But when the curve starts to invert, like we have seen in recent years, things get complicated real quick. An inverted yield curve is when the 2-year Treasury pays more than the 10-year. Think about how insane that is. It's like a hotel charging you $500 for one night, but only $200 a night if you stay for a whole month. It makes 0 sense. Unless you know a Category 5 hurricane is hitting the coast tomorrow. When the curve inverts, the bond market is screaming at the top of its lungs. It's saying, I am terrified of the next 24 months. I'm charging a massive premium to survive the short term because I think the long term is a disaster. This isn't just a theory. Since 1955, an inversion of the yield curve has preceded every single U.S. recession, with only one false signal back in the mid-60s. That's a better track record than any economist, any president, and any AI algorithm on the planet. Why is it so accurate? Because it represents the collective intelligence of the biggest pool of money on Earth, When the people who manage trillions of dollars decide they would rather lock their money up for 10 years at a lower rate than keep it in the 2-year market, they are telling you they expect rates to be much, much lower in the future. And why would rates be lower in the future? Because the Fed will be forced to cut them to zero to save a dying economy. For the last 2 years, we had the longest inversion in history. We stayed below the zero line for over 600 days. The media called it different this time. They said the old rules didn't apply because of the post-pandemic stimulus. They were wrong. The bond market doesn't care about your new era theories. It only cares about the math. As of early 2026, that warning light just turned off. The curve is positive again. Most people think the danger is over. They're wrong. Inversion is the warning. De-inversion, the moment we are in right now, is the landfall. Think of it this way. The inversion was the Fed slamming on the brakes. The car is screeching, the tires are smoking, but you haven't hit the wall yet. The de-inversion is the moment the car actually starts to skid across the pavement. In every recession since the 70s, the economy didn't break during the inversion. It broke after the curve returned to normal. Look at 2000. Look at 2008. The stock market often hits new highs right as the curve uninverts. The stock market is shouting, "Bro, we made it! Soft landing!" Retail investors see the curve going back to normal and think, "Whew, the water is safe again." Meanwhile, the pros are selling. They know that a curve doesn't uninvert because things are getting better. It uninverts because the front end is collapsing. The 2-year yield is falling because the market smells a panic. In 2026, we are watching the great recalibration. The Fed is trying to walk a tightrope, but the bond market has already moved on. The arbiter of risk has decided that the damage from the high-rate era is already baked into the system. The zombies, those companies that only survived on 0% interest, are starting to gasp for air. To read the curve like a pro, you have to know why it's steepening. This is where 99% of investors get it wrong. They think, green line up equals good. In the bond market, it depends on which side of the line is moving. The bull steepener, the panic move. This is what we are seeing in 2026. The Fed realizes they've finally broken something. A major bank, the commercial real estate market, or the consumer. They start panic cutting short-term rates. The 2-year yield collapses faster than the 10-year. Why is it called bull? Because it's bullish for bond prices. But for the economy? It's a disaster signal. It's the Fed admitting they stayed too high for too long. It's great for gold and Bitcoin because they thrive on Fed panic, but it's a death sentence for bank profit margins. The bear steepener, the inflation move. This is the darker twin. This happens when inflation gets out of control and the national debt, now over $38.4 trillion, finally scares investors. Instead of the 2-year falling, the 10-year yield skyrockets. Investors dump long-term bonds because they don't trust the government to pay them back with real money. This is the bond vigilantes coming out of retirement. This is the faith is lost signal. In 2026, we are seeing a Frankenstein version of both. We have a Fed that wants to cut to save the zombies hitting the maturity wall, but we have a Treasury Department flooding the market with new debt to pay the interest on the old debt. This keeps long-term yields high while short-term rates fall. It's a bull on the front end and a bear on the back end, a tug of war that is tearing the financial system apart. It's a steepener that offers no safety. There's another reason the dashboard is flashing red: the return of the term premium. For 40 years, we lived in a fantasy land. Interest rates only went down. Every time there was a hiccup, the Fed printed more money and bought bonds. This suppressed the term premium, the extra interest you should get for lending money for a long time. But with over $38.4 trillion in debt, the math has changed. The government is now adding billions a day to the tab just to pay the interest on what they already borrowed. Traders are now demanding a risk premium just to hold long-term debt. This is a nightmare for the affordability apocalypse. Usually when the Fed cuts rates, your mortgage goes down. But in 2026, If the term premium stays high, currently hovering near 0.8%, your mortgage rate stays at 6% or 7%, even if the Fed goes to fully easing mode. The golden era of cheap long-term money is in the history books. So how do you use the dashboard to survive? First, watch the 2s-10 spread. We've blown past the plus 30 basis point danger zone and are sitting near plus 70. This is the De-Inversion Trap. The market is no longer predicting rate cuts. It's demanding them because forced selling has already begun in the shadows. When this spread moves too fast, it's a sign that liquidity is drying up. Second, watch the maturity wall. There is nearly $1.8 trillion in corporate and real estate debt coming due this year. These companies aren't like you. They don't have 30-year fixed mortgages. They have floating or short-term debt that they have to roll over. Because the curve is now steep, meaning long-term rates remain high, these companies can't refinance at the 2% rates they're used to. They are hitting a wall of 8% interest. They will break. And when they do, credit spreads will explode, and that's when the real stock market crash begins. Third, don't fight the Fed, but don't trust them either. The Fed is a lagging indicator. They react to what happened 6 months ago. The yield curve is a leading indicator. It tells you what will happen 6 months from now. If the Fed says soft landing, but the curve is steepening like a mountain, believe the curve. Most people ignore the yield curve until it's too late. They wait for the news to tell them we're in a recession. But by then, the pros have already moved into cash, gold, and defensive positions. The dashboard is flashing red. The Godzilla of the global margin call is waking up. If you can read the line, you can survive the storm. I've spent 20 years watching these lines move. They are the only thing I trust. In a world of mean tweets and Fed drama, the yield curve is the only piece of reality we have left. I'm the Bond Bro. Stay solvent.